And welcome to all of our listeners and viewers around the country and around the world. President Obama is leaving today for a 10-day visit to Asia with scheduled stops in India, Indonesia, South Korea, and Japan. In South Korea, Obama will attend the G20 meeting where U.S. monetary policy is expected to be high on the agenda. On Wednesday, the Federal Reserve said it will pump $600 billion more into the U.S. economy and keep interest rates at historically low levels. The short-term impact of the Fed's move, known as quantitative easing, has been a jump in stock prices across the globe. But many nations have accused the U.S. of waging a currency war by devaluing the dollar. Brazil's president-elect Dilma Rousseff said, quote, "The last time there was a series of competitive devaluations, it ended in World War II." China has accused the U.S. of uncontrolled money printing. By devaluing the dollar, the Fed is cheapening the price of U.S. exports and making foreign imports more expensive. In addition, the low interest rates are encouraging U.S. corporations to make massive investments overseas, cheaply buying up foreign real estate, natural resources, and stock.
Our next guest, Michael Hudson, says finance has become a new form of warfare. Michael Hudson's distinguished research professor at University of Missouri, Kansas City. A former Wall Street economist, he's the author of many books, including Super Imperialism, the Economic Strategy of American Empire. Michael Hudson, welcome to Democracy Now! Why warfare?
Well, the object of warfare is to take over a country's land, raw materials, and assets, and grab them. And in the past, that used to be done militarily, by invading them. But today, you can do it financially, simply by creating credit, which is what the Federal Reserve has done. It's created $600 billion. It hasn't gone into the economy. The head of the Fed is known as Helicopter Ben because he talks about dropping money into the economy. But if you see helicopters, they're probably not your friends. Don't go out and wait for them to drop the money because the money's all going electronically into the banks. And the Fed has said, we want to give the banks so much money that they'll lend it out so you can begin to bid up prices on real estate again and pull the banks out of the real estate negative equity that it's in. So the purpose, according to the Fed, is to raise the price of real estate, to inflate asset prices. But that's not happening. The actual banks have lent less today than they did in 2007. So the money's going abroad. And it's going abroad not really to buy foreign companies so much, but to speculate in currency. Now, the Fed and the Congress 2 weeks ago said, we want China to raise its currency by 20%. This would create billions and billions of dollars of bonanza for Wall Street banks, and it would enable them to earn their way out of debt by essentially looting the China Central Bank, the Brazilian Central Bank, the Turkish Central Bank, and the other central banks, because you can now borrow money in America at 1%. So you'd put down, let's say, $1 billion of your own, $1 million of your own money, borrow $99 million of the bank's money, that's $100 million. You'd buy Chinese currency, RMB, for $100 million. You then say, raise your currency by 20%, which is what the Fed's asked them to do. That means that your $1 million now is turned into a $20 million gain because $100 million is now worth $120 million. You've made a 200% profit. And for Wall Street, they deal in billions, not millions. And so this would enable the banks to make up their money by buying essentially foreign currency. They're doing the same in Australia. It's currency gamble.
Well, and meanwhile, the impact, because obviously this decision was made the day after the elections and at the Fed meeting. They saw what the political landscape was. There wasn't going to be any kind of stimulus coming from Congress, so they had to come up with a stimulus for Wall Street the day after the elections. But the impact on the American people of maintaining these historically low interest rates, as we were talking earlier before the show, if you have a little bit of money in a savings account right now, you're getting virtually no interest. So you're in essence being pressured to end up going into the stock market to be able to get any kind of return on your money. Those who still have savings. The same thing with the pension funds. What's happening to the American people as a result of this same kind of policy?
Well, if they have money to put in pension funds or savings, they're only able to get about 1% if they keep it safe. Otherwise, they're taking a risk in the stock market. But the key is not simply lowering interest rates. The idea is to flood the economy with credit it, so the banks will lend out more debt, and if the Fed's policy works, then housing prices are going to go back up so high that most consumers are going to have to pay 40% of their income for housing. They're going to have to pay more money for credit card debt. The purpose is to help the banks make money at the expense of the economy. It's not to help the economy at all. That's the really important thing. When they say the economy, they mean the Fed means its constituency, the banks, and the bank's product is debt, and that's what they're trying to prevent.
Is this inflationary?
It will inflate asset prices. It won't inflate consumer prices. It's actually deflationary for consumer prices, because if you're an American consumer and you spend 40% of your income for housing, 15% for debt service to the bank, 11% goes out in your FICA wage withholding, and about 10 to 15% in actual income taxes, that means that the average American has maybe 1/3 or 1/4 of their salary to actually spend on goods and services. So they have to spend so much on debt service and finance and insurance and real estate that there's no money to buy goods and services. So that's why so many stores are closing throughout the cities on the big shopping streets. It's deflationary for the economy, inflationary for the people who have wealth, inflationary for the banks, and it's the banks really at the expense of the economy.
But there is the reality now that the world has changed dramatically over the last 30 or 40 years, and you have now this sort of new independent force on the world scene, even in finance, which is the countries like China, Brazil, and other countries of the third world that are, in essence, standing up on some of these issues. What's happening in terms of their reaction?
The world is dividing into two currency blocks, and over the last few months, China has gone to Turkey, Malaysia, Thailand, and said, we want to avoid using the dollar altogether. They're treating it like a pariah currency. They're saying, well, let's make a currency swap. We'll give you our Chinese RMB, you'll give us your currency, the baht, and we'll do our trade in our own currency. We are isolating the dollar so that people are not going to use the dollar anymore. That's why the dollar is plunging on world foreign exchange markets. The whole world that America created after World War II of open markets is now closing off. And it's closing off really because the United States is trying to rescue the real estate market from all the junk mortgages, all the crooked loans, all of the financial fraud, instead of just letting the fraud go and throwing the guys in jail like other economists have suggested.
I want to play a comment from the Nobel Prize-winning economist Joseph Stiglitz. We interviewed him recently. He was talking about the Federal Reserve and its attempts to inject liquidity into the U.S. economy.
So the money isn't going into the American economy. Lending is actually below what it was in 2007. In a globalized economy, the money is looking for the best place to go. And where is it finding it? In the emerging markets. So the irony is that money that was intended to rekindle the American economy is causing havoc all over the world. Those elsewhere in the world say what the United States is trying to do is the 21st century version of beggar-than-neighbor policies that were part of the Great Depression. You strengthen yourself by hurting the others. You can't do protectionism in the old version of raising tariffs, but what you can do is lower your exchange rate. And that's what low interest rates are trying to do, weaken the dollar. The flood of liquidity abroad is trying to push the exchange rates abroad, and they're saying we can't allow that.
That's economist Joe Stiglitz. Professor Hudson, your response.
That was, I think, the best interview on your show that Professor Stiglitz has ever done. Last Saturday, I was in Germany at an economic meeting, and we were discussing this very interview there. And what they're pointing out is that in Europe, in Germany, and all of Europe, it's illegal for the central bank to finance government debt. All of Europe is being subjected to austerity now because of the way in which their constitution is written. So they're saying, wait a minute, when we run a deficit, we have to raise interest rates and impose austerity. And in the United States, they are doing just the opposite. They're lowering interest rates to buy us out. And the interview that Professor Stiglitz here was quite right. America is doing all of this. The Fed is doing this to cover up the huge fraud that he talks about. He's right. These people should be in jail, and you shouldn't bail them out. You're keeping the debt that was run out by the junk mortgages and the fraudulent lending. You're keeping that in place, pricing American labor out of the market and making it impossible for America to earn its way out of debt. So in Europe, they're saying, how can America ever repay these dollar debts that they're running up? They can't repay, and that's why the euro is going up against America. And that's why they say, we want to now talk to the BRIC countries, to China, to the third world, and move into a currency area with them and just isolate the dollar so they can't do the kind of financial warfare that they've been engaging in.
Well, in terms of how countries can respond, one of the things that obviously a lot of the Asian countries did during the financial crisis in the late 1990s was currency controls, in essence trying to prevent foreign capital from either leaving or entering the country. Is that something that you envision some of these countries
yes,
beginning to do?
There was only one country that did that, and that was Malaysia under Prime Minister Tun Muhammad Mahathir. He would not sell the domestic currency to the foreign speculators, so George Soros and the others who sold the currency short, hoping that the central bank would use all of its money just to defend its currency and then be emptied out, they couldn't cover their position. So they were squeezed. But countries like Korea, where the meetings, the G20 meetings are this week, the IMF went and said, you owe money, you can't pay, George Soros has raided you, you have to sell Americans, your electric companies, you have to sell Americans, your car companies, and this was a grab that in past centuries, there would have had to be a military invasion to take over, and now they're doing it financially, and they're angry over there.
You were advising Kucinich when he was running for
Yes.
president. What do you think President Obama should do, and what do you think he did wrong, since people say it's the economy that took him down in the elections?
He has always represented Wall Street's interest. The deal, his protector in the Senate was Joe Lieberman, and part of the Democratic Leadership Council. And during the last presidential campaign, he won because he said he was for change. And Dennis Kucinich kept saying, here is the change in the law that I've recommended. He said exactly what he would do. Mr. Obama never said what he would do, and it's obviously the case that he saw that the public wanted change. If you want to get elected, you say there's for change. But what he's turned into is the third Bush-Cheney administration. He's reappointed the worst of the Bush people, like Tim Geithner at the Treasury Secretary. He's kept on the most right-wing of the Clinton people as his economic advisors. He is essentially in Wall Street's pocket, and that's not change at all. And that's why so many people were so disappointed. They believed that he was going to be for change, and he's a good speaker, but he had no intention of doing the change at all, as we now see. And he still has not come out and said that America needs anything except more debt, more bailouts for the banks. People were angry because the banks were bailed out, and now the Republicans were saying he didn't give them enough. They're angry because he didn't give Wall Street enough and cut taxes enough on the rich. That's not why people were angry. They're angry because he gave money to the rich, the exact opposite. So I guess you could say Mr. Obama and Mr. Kucinich are at opposite ends of the political spectrum.
What should he do right now?
What he should do is essentially bring the debts down to the ability to pay. He'd promised that he was going to renegotiate mortgages to the current value of housing. That would mean writing down housing by about 30%, so it could be affordable again. But he hasn't done that. In the government, he has prevented the state attorney generals from prosecuting financial fraud and from forcing the banks to renegotiate the mortgages down to what American consumers can afford. And Mr. Obama has blocked this, and so all 50...
And also what the real value of many of those properties are.
Either the market price or the rental price. So essentially, people would pay to own a house pretty much what you'd pay to rent. That's the definition of equilibrium in economics. But right now they're paying much more on their mortgage than they could go and rent an apartment for, and they can't afford it. People are out of work, and the result is that there's a debt squeeze, and so that's why I said this is deflationary, not inflationary. What should be inflated are American wages, American living standards, tangible investment. Instead, what's inflated is debt and the financial sector at the expense of the production and consumption.
What do you expect to happen at the G20 meeting that's coming up now?
The same thing that happened 2 weeks ago. Absolutely nothing. They will all agree that the soup was very good, that the food was nice, and that they will have further discussions, but America will not get any of what it's asking for from them, because they're going to say, look, we're not going to let you create electronic keyboard credit and buy out our real estate and our industry and empty out our bank reserves like you did in the 1997 Asia crisis. That's never going to happen again, and the world is going to begin splitting into two currency blocks, the brick block and the dollar block.
We're going to have to leave it there. Michael Hudson, president of the Institute for the Study of Long-Term Economic Trends, distinguished research professor of economics at University of Missouri, Kansas City, author of Super Imperialism, the Economic Strategy of American Empire. This is Democracy Now! Back in a minute.
Thank you very much.
Black Monday. That's how economists are describing yesterday's market turmoil, which saw stock prices tumble across the globe from China to Europe to the United States. China's stock indexes fell over 8% Monday and another 7% today. On Wall Street, the Dow Jones Industrial Average initially fell a record 1,100 points before closing down nearly 600 points. The decline also caused oil prices to plunge to their lowest levels in almost 6 years. Joining us now to try to make sense of what's really behind the fluctuations in the market is economist Michael Hudson, president of the Institute for the Study of Long-Term Economic Trends, a Wall Street financial analyst, and distinguished research professor of economics at the University of Missouri, Kansas City. His latest book, Killing the Host, How Financial Parasites and Debt Bondage Destroy the Global Economy. Welcome to Democracy Now! It's great to have you with us.
Thanks for having me.
Professor Hudson, talk about what happened in China and what happened here in the United States.
Well, what happened in China doesn't have very much to do at all with what happened in the United States. Wall Street would love to blame China, and the Obama administration would love to blame China, and Europe would love to blame China. But most of the Chinese stocks went down because small Chinese investors were borrowing from, let's say, the equivalent of payday loan lenders to buy stocks. There was a lot of small speculation in Chinese stocks pushing it up, but this was an internal Chinese phenomenon, and China as a whole doesn't really have the problems. The real problem is that we're still in the aftermath of the when the bubble burst in 2008, that all of the growth in the economy has only been in the financial sector and the monopolies, only for the 1%. And it's as if there are two economies, and the 99% has not grown. And so the American economy is still in a debt deflation. So the real problem is stocks have doubled in price since 2008, and the economy for most people, certainly who listen to your show, hasn't grown at all. So finally, the stocks were inflated really by the central bank, by the Fed creating an enormous amount of money, $4.5 trillion, essentially to drop over Wall Street, to buy bonds that have pushed the yields down so high, so low, to about 0.1% for government bonds, that pension funds and investors say, how can we make money? So they buy stocks, and they've borrowed at 1%. To buy up stocks that yield maybe 4%. But who are the largest people who buy the stocks? They're the companies themselves that have done stock buybacks. They're the managers of the companies that have used their earnings essentially to push up stock prices so they get more bonuses. 90% of all the earnings of the biggest companies in America in the last 5 years have gone for stock buybacks and dividends. It's not being invested. It's not building new factories. It's not employing more people. So the real problem is that we're in a non-recovery in America, and Europe is in an absolute class war of austerity. That's what the Eurozone is, an austerity zone. So that's not growing, and that's really what's happening. And all that you saw on Monday was just sort of like a tectonic shift, as people realizing, well, the game's up, it's time to get out, and once a few people want to get out, everybody sees the game's up.
And China?
In China, it's largely small borrowers who have borrowed from intermediate lenders that have borrowed from the big banks. So a lot of individuals in China that tried to get rich fast by riding the stock market all of a sudden find out that they have a lot of debt to intermediate, non-bank lenders, insiders, people who banks will lend to. It's like the British banks lending to real estate speculators to lend out to home buyers. So this is essentially the attempt to get rich by riding the stock market in China went way overboard. Chinese stocks are still above what they were at the beginning of the year. This is not a crisis. This is not very much. It's just that the artificial increase in the market has now ended some of the artificial push-up, and it's still artificial, and it'll still go down some more.
I'm surprised you say that what happened in China, what happened in the United States are not related.
They are related in a way, but the U.S. Funds have not invested very much in the Chinese stocks. Most of the China fund stocks are in HSBC, which lends to China, the bank. The break first happened in China, but the break itself was within China, and this showed investors this is a symptom that what happened in China is going to happen in Europe, and it's going to happen in the United States.
Talk about China as the world's second largest economy and what you think would be the healthiest relationship between China and the United States.
Well, the economy is not the stock market. China's economy had to accumulate a large amount of foreign reserves just to withstand the kind of American financial war that brought the Asia crisis of 1997. So China acted defensively. It exported a lot, developed huge international reserves to make itself independent of the West, and now it's in the middle of shifting away from an export economy to begin to produce for its own people. I mean, why should Chinese workers spend all their lives making goods for Walmart to sell in the United States and Europe? Why don't they make goods for themselves to raise their own standard of living? That was what China's doing, and that means that China doesn't have to export more, and there's really nowhere to export to. If Europe isn't growing and the U.S. consumers aren't spending, obviously the attempt is to make China itself grow, but the Chinese took the money, instead of consumer goods, they bought stocks.
As markets in China plunged Monday, former U.S. Treasury Secretary and President Emeritus of Harvard University, Larry Summers, tweeted this dire prediction. As in August 1997, 1998, 2007, and 2008, we could be in the very stage of a very serious situation. Is he overstating what's going on?
The question is, what does he mean by situation? When he says situation, he means his constituency, the 1%. He doesn't mean the economy as a whole, the 99%. He's been wrong on almost everything that he's called. What he's calling for now is you have to cut taxes on the 1% more. You have to give the 1% more money, and it'll all trickle down. This is part of his patter talk, trying to support his usual right-wing position. But you have to be very careful when you listen to Larry Summers.
Michael Hudson, your book is titled Killing the Host: How Financial Parasites and Debt Bondage Destroy the Global Economy. Explain what you mean.
Well, most people think of parasites as sort of just taking money from the economy, and the 1% is sort of sucking up all the income from the 99%. But in nature, what parasites do, they don't simply take. In order to take, they have to take over the brain of the host. And economists have a word, host economy. It's for a foreign country that lets American investors in. Smart parasites help the host grow, but the parasite, first of all, has to make the host believe that the intruder is actually part of the body, to be nurtured and taken care of. And that's what's happened in national income accounting in America and in other countries. The newspapers and the media, not your show, but most of the media, treat the financial sector as if that's really the economy. And when the stock market goes up, the economy is going up. But the economy isn't going up at all. And the financial sector somehow depicts itself as the brains of the economy. and it would like to replace government. What Larry Summers said is what governments have to pay their debts by privatizing more, essentially by doing what Margaret Thatcher did in England. That's his solution to the crisis. All the governments have to do is balance the budget, sell everything to Wall Street on credit, and we won't have any more problem. And that's basically, the financial sector is almost at war, not only against labor, as most of the socialists talk about, but against governments and against industry. It's a cannibalizing industry. So now most of the corporations in America are using their income not to do what industrial capitalism did a century ago, not to build more factories and employ more people and make more profits. They're just using it, as I said, to push it to pay dividends and to buy back their shares and to somehow manipulate the financial sector and the stock prices, not the economy as a whole. So there's been a divergence between the real economy and what I call economists call the fire sector, finance, insurance, and real estate, and they're going in separate directions.
You have been an advisor to the Syriza party in Greece. You're a friend of the former finance minister, Yanis Varoufakis. Can you talk about what's happening there now and what that bodes for the economy, not only in Greece, but in Europe, maybe even here?
Well, the story begins actually about 4 years ago when Greece had a very large foreign debt taken on basically by the military government and what followed. And it was obvious that as soon as the PASOK, the Socialist Party, came in, they said, look, the debt's much larger than we thought. We can't pay it. And they were going to write it down. The IMF looked in and said, Greece can't pay the debts. We've got to write them down. The board looked in, said they can't pay the debts. But then the European central banks came in and said, look, our job as central bankers is to support the banks. Greece owes the debt to essentially French banks and German banks, and we've got to support them. So despite the fact that the IMF was pushing for a debt write-down 4 years ago, the head of the IMF at that time, Dominique Strauss-Kahn, wanted to run for president of France. And he was told by French President Sarkozy, well, wait a minute, if French banks hold most of Greek debts, you can't, at the IMF, say that we're going to write down the debt. So they didn't. And meanwhile, the Eurozone said, we won't let you, the IMF, be part of our program, the Troika, if you don't pretend that that Greece can pay the debt. So Greece was left with a huge debt. It was pushed into depression. The GDP fell worse than it did in the 1930s. Finally, the Syriza party came in January. And Varoufakis and Tsipras thought that, okay, we can explain to the finance ministers of Europe that you can't expect to push Greece into a depression, push more austerity, and somehow austerity will enable us to repay the debt. That's crazy. And he thought that he could reason with them. And the Europeans who he was reasoning with, the central bankers, said, we're not here to talk about economics. We're lawyers. We're here to collect money. It doesn't matter that you're going to go into a depression. It doesn't matter that you're going to have another 20% of your population emigrate. We're only here to collect the payments. And if you don't pay, then we're going to pull the plug. And they pulled the plug on the Greek banks a few months ago and said, we're not going to accept any of the bank transfers payments with Greek banks here. So if you're exporting and you want credit for export, you're not going to give it to you. We're going to treat Greece like America treated Cuba and America treated North Korea. You're going to be the North Korea of Europe if you don't surrender and pay. And that's why Tsipras said, we don't want to bring an absolute, total crisis breakdown, because that would bring the right wing to power. Varoufakis said, well, he agrees that there's no alternative but to sort of surrender for the present and try to join hands with Italy, Spain, and Portugal. But he wasn't going to be the administrator of the Depression. So you had the referendum, and the Greeks now say, well, we're no matter what, we're not going to pay. And the Eurozone says, then we're going to just wreck you or smash and grab.
I want to ask you very quickly about presidential politics, about two of the Republican presidential candidates, Jeb Bush and John Kasich. Both work for Lehman Brothers. Kasich, after he ran after he was a congressman. Jeb Bush, according to the Wall Street Journal, Bush signed on with Lehman after leaving the Florida governor's mansion, making it clear he he wanted to work as a hands-on investment banker. I believe he made something like $14 million working for Lehman and then Barclays.
Well, almost both parties are basically run by Wall Street. The Democratic Party, ever since Bill Clinton, was run by Robert Rubin. And all of the secretaries of the Treasury, the officials, have basically come from Goldman Sachs, especially Tim Geithner. One of the problems in Greece, by the way, was that Obama and Geithner, coming from the Rubin group, met at the Group of 8 meetings and were told, basically Greece, you have to pay because the American banks have made so many big bets on Greek bonds that if Greece doesn't repay, this is back in 2011, then the American banks will go under, and if we go under, we're going to pull Europe down. So the American banks, basically, we're talking about Wall Street investment firms. They're called investment bankers, but they don't invest. They gamble. And we're really much more in casino capitalism than finance capitalism. So you have Wall Street people basically running politics, whether they're the actual politicians. Obama didn't work on Wall Street, but he worked with the real estate families. No matter who the president is, they're going to appoint Treasury heads and Federal Reserve heads from Wall Street. Wall Street has a veto power on all the major cabinet positions, and so essentially the economy is being run by the financial sector for the financial sector. That's the problem with politics in America today.
Michael Hudson, thank you very much for being with us, president of the Institute for the Study of Long-Term Economic Trends, a Wall Street financial analyst, distinguished research professor of economics at the University of Missouri, Kansas City. His latest book, Killing the Host: How Financial Parasites and Debt Bondage Destroy the Global Economy.